Let's start with the ECB. Lizzie was setting us up there with our expectations. The future of Christine Lagarde, a cut in prospect in today's meeting, it would seem. What are you going to be focused on, from inflation successes to growth challenges?
Morning, Anna. As Lizzie was mentioning, I think a cut is almost a given. There was only one kind of dissent going into from what we have heard from recent speakers in recent days. But I think that, the cut is a given, but the question is what happens beyond today. I think that the ECB, considering that the trade talks with the US are still ongoing and there is the uncertainty that the US may bring back tariffs, it is possible that the ECB will want to keep its ammunition dry for another day, which means that they will want to signal that there's going to be a pause in rate cuts going forward. I think that many people on the Governing Council already think that 2% is the nominal neutral rate, and we will be approaching that this afternoon. So the question is, how are they going to communicate that? It's going to come down to the language of the statement. I think that they have previously indicated that they are going into a data-dependent and meeting by meeting approach. And I think they are going to tweak that language or introduce new language to suggest that they are going to be on hold after today's cut. I think possibly the next cut could come in as late as in September. So I think that, if you look at German front-end bonds, they are fully priced for this outcome. So any kind of revisions to the macroeconomic forecasts that are not as dovish as the market thinks may put some pressure on front-end German bonds.
OK, so watch front-end German bonds and scrutinise the statement and the language there. Talking of bonds, you've been doing a deep dive into some of the mechanics and the history of the Treasury market and what it tells us about opportunities now then. There's been this favoured trade, the steepener trade, where you pile into the front end and you steer clear of the long end. Is that the right place to be? What does your analysis show in terms of where to sit along that Treasury curve?
So, Tom, what we did was we looked at the, how bond market returns have fared after major spikes in volatility. So we went back in data like 2 decades. And so we looked at various thresholds of spike in volatility, i.e. the MOVE index, and measured the returns on bonds, various segments of the bond treasury curve, exactly 1 year after those spikes in volatility, based on some predefined thresholds on the MOVE index. Now, what we found was a bit of a surprise. What we found was that the front end didn't do really well, which is not what you would expect really, because when there is a spike in volatility, it usually accompanies some distress in the economy. And that is the time when the Fed comes out and says, we need to accommodate the weakness in the economy. We will cut rates. So you would expect the front end to do well in that scenario. But that's not what we saw in the analysis. Another key finding in the analysis was that the 7 to 20 year segment of the markets do the best in the long term.